Gold just hit $5,000. Silver 78. Oil up 12% in 30 days. Trump gave Iran 10 days to comply or face military action. Nuclear-capable bombers are already on the ground in Qatar, 720 miles from Tehran. China's silver market is in backwardation at record levels, meaning people are paying premiums to get metal now instead of waiting. Shorts are paying fees to avoid taking delivery because there isn't enough physical metal to deliver. First Majestic just posted $464 million in revenue, with silver production up 77%. And for 2 consecutive years, there have been 0 new gold discoveries anywhere on Earth. That has never happened in recorded history. This isn't a rally. This is the awareness phase of a structural collapse that's been building for decades. Most people will ignore this until it's too late because they want to be told everything is fine. They want someone to validate their belief that the system can continue indefinitely. That's not what you're getting here. What you're getting is central bank data, settlement documents, and supply chain reports that most will never read, because reading them means admitting the story they believed was a lie. Every empire that ever existed followed the same pattern. Expansion, debt accumulation, currency debasement, collapse. Rome did it. The Dutch did it. The British did it. Now it's our turn, and the sequence is identical. Rome started strong, conquered half the known world, built infrastructure that lasted centuries. But wars are expensive. Maintaining an empire is expensive. So they started debasing their currency. The denarius went from pure silver to nearly worthless metal wrapped in a thin silver coating. Soldiers refused to accept it. Trade collapsed. Inflation destroyed savings. The empire fragmented. Verified. The Dutch built a global trading empire in the 1600s. They controlled the spice trade, established colonies, created one of the first central banks. Then came the wars with England and France. Debt exploded. They kept printing money to fund military campaigns. The guilder lost its value. Capital fled to London. The empire crumbled. Verified. Britain controlled a quarter of the world's surface at its peak. The pound sterling was the global reserve currency. Everyone settled trade in pounds because it was backed by gold and the world's most powerful navy. Then came 2 world wars. Debt went parabolic. They had to choose between defaulting or abandoning the gold standard. They chose debasement. The pound collapsed. The dollar took over. Empire over. Verified. Same pattern. Same sequence. Same outcome. Now look at where we are. U.S. government debt is projected to hit $64 trillion by 2036, and that's the optimistic scenario assuming no recession, no war, no financial crisis. During World War II, when U.S. debt reached extreme levels, 51% of it was backed by gold reserves. Today, total debt is even larger, yet only 3% is backed by gold. If the U.S. tried to back its debt at the same ratio as the 1940s, gold would need to be worth $75,000 per ounce just to make the math work. That's not speculation. That's arithmetic. The federal government is now spending more on interest payments than on defense. Let that sink in. We're not funding roads or schools or infrastructure with borrowed money anymore. We're borrowing money just to pay the interest on money we already borrowed. That is the definition of a debt spiral, and there are only 2 ways out: default or debasement. Default means the government admits it can't pay and the entire financial system collapses overnight. Debasement means they print currency until the debt becomes manageable in nominal terms, but your savings, your salary, your retirement account all become worthless in real terms. History shows they always choose debasement because it's politically easier. You can blame inflation on external factors. You can't blame default on anything but yourself. Central banks know this. That's why they've been buying gold at record pace since the global financial crisis. For 2 decades before that, central banks were net sellers of gold. They believed the dollar was stable, U.S. treasuries were safe, and gold was a relic. Then 2 things happened. First, the financial crisis showed that the U.S. banking system could implode and take the world with it. Second, the seizure of Russian assets and the removal of Russia from the SWIFT payment system showed that holding dollars in treasuries comes with political risk. If the U.S. doesn't like your government, they can freeze or confiscate your reserves with the click of a button. So central banks, especially in the East, doubled their gold purchases. They're not doing this because they think gold is going up. They're doing this because they know the current system is ending. We are watching the remonetization of gold in real time. The bifurcation of the world into 2 monetary systems. The West is still betting on the dollar-centric system, on paper promises and digital ledgers. The East is moving to a gold-centric system where gold is once again the preferred reserve asset. This isn't theory. This is documented in central bank reserve data published quarterly. Now look at what's happening in the physical silver market. In China, the front-month silver contract is trading at a record premium over future delivery. That's called backwardation, and it signals one thing. There isn't enough metal available now. Buyers are willing to pay more for immediate delivery than for a promise of delivery later. Warehouse stocks linked to the Shanghai Futures Exchange are at levels last seen more than a decade ago. Merchants in Shenzhen say whenever stocks appear, they're sold off within hours. Short sellers, the institutions betting that silver prices will fall, are paying deferral fees to avoid taking physical delivery because if they're forced to deliver metal they don't have, they'll be exposed. This is a physical squeeze happening in the second largest economy on Earth, and most people in the West have no idea it's occurring because it's not reported in mainstream financial media. At the same time, there's been a structural shift in where silver is going. Over the past several months, silver concentrate from Latin America, which used to flow to Asian refiners, is increasingly being redirected to U.S. refining capacity. This aligns with a broader strategy to secure critical mineral supply chains within the Western Hemisphere. If concentrate that would normally go to China is now staying in the Americas, that creates a supply bottleneck in the East. It's not just a temporary shortage. It's a realignment of trade routes that could persist for years. And it's happening while solar panel production, which consumes massive amounts of silver, continues to grow. While investment demand for silver bars and coins is surging. While industrial applications for silver in electronics and 5G infrastructure are expanding. Supply is being rerouted. Demand is accelerating. Inventories are at decade lows. This is the setup for a price explosion, not a correction. First Majestic Silver just reported numbers that confirm what's happening at the production level. Record quarterly silver production of 4.2 million ounces, up 77% year-over-year. Revenue of $463.9 million, up 169% from the same quarter last year, with 60% of that coming from silver. Cash flow from operations hit $301 million. Net earnings flipped to $105.2 million from a loss the prior year. Free cash flow reached $250.4 million, nearly quadrupling prior results. And their treasury swelled to $937.7 million in cash, triple the prior year level. They're not just surviving in this market. They're thriving. And starting in Q1 of 2026, they're doubling dividends to 2% of net quarterly revenues. This is what happens when a mining company operates in an environment where metal prices finally reflect supply and demand fundamentals instead of decades of paper suppression. When producers post record profits, quadruple free cash flow, and triple their cash reserves, that's not a company-specific story. That's a signal of a structural shift across the entire sector. But here's what most people don't understand about mining. There is no new supply coming. For the first time in recorded history, there have been zero gold discoveries in 2 consecutive years. Not small discoveries. Zero discoveries. The discovery pipeline for most metals has collapsed. Major discoveries across the board have fallen into single digits, and there are no meaningful projects in the pipeline capable of materially altering the global supply curve. Mining takes years, often decades, from discovery to production. You can't just flip a switch and produce more metal when prices go up. The projects that would supply metal in 5 or 10 years needed to be started 5 or 10 years ago, and they weren't because prices were suppressed for so long that exploration budgets were slashed. Now prices are rising, demand is accelerating, and there's no supply response possible in the near term. This is the setup for a supply-driven supercycle, and we're only in the early stages. The mining sector as a whole is sitting at just 4% of global assets. The historical average from 1921 to 1981 was 24%. That means the sector would need to increase 6 times just to revert to the mean. Silver mining equities are trading at historic valuation lows relative to the metal itself. Most primary silver producers are operating with all-in sustaining costs well below $20 per ounce, yet their stock prices only make sense if silver falls back to those levels. The market is pricing in a collapse that isn't coming. It's pricing in a supply response that can't happen. And it's ignoring the fact that institutional capital is historically underweight in mining while fundamentals are historically bullish. When that capital finally rotates into the sector, and it will, the move won't be gradual. It will be violent. Now at geopolitics. Trump just gave Iran a 10-day deadline. He said the U.S. must reach a meaningful deal and that if talks fail, the U.S. may have to take it a step further. He warned that bad things will happen because Iran cannot be allowed to possess a nuclear weapon. This isn't abstract. Nuclear-capable B-52 bombers are already positioned at Al Udeid Air Base in Qatar, just 720 miles from Tehran. Prediction markets spiked on reports of a possible strike, pushing odds to 54%. Additional forces and missile defense systems have been deployed to the region. U.S. crude oil futures have extended gains to 12% over the past month, reaching their highest level since August 2025. Wars are inflationary. History proves this. When geopolitical risk shifts from abstract to imminent military action within a specific time frame, markets reprice everything connected to conflict. Energy, strategic materials, safe haven assets, all move simultaneously. The ones who read primary sources know conflicts don't just impact oil. They redirect capital flows toward hard assets and physical supply chains, while paper promises get questioned. We are not at the cliff. We have already walked off it. The question now is how long it takes for people to look down and realize there's nothing beneath them. The S&P is flashing a rare signal that typically precedes major directional moves. 54% of stocks are currently overbought, the highest percentage since June 2025. At the same time, 26.8% of names are oversold, the highest since October. Under normal market conditions, these metrics move in opposite directions. This means a significant number of stocks are seeing aggressive buying and selling simultaneously. Last Friday marked only the 13th day since 2007 where both the proportion of overbought and oversold stocks rose by more than 10 percentage points over a single month. This represents a rare shift in price action, and historically, it precedes major moves. The market is fracturing. Some stocks are being aggressively accumulated. Others are being dumped. This is not the behavior of a stable, confident market. This is the behavior of a market where big players are repositioning for something they see coming. Here's how the manipulation works, and this isn't theory. It's documented. Banks flood the screen with giant fake sell orders, millions of ounces, making it look like huge supply is about to hit the market. Bots and scared traders see that wall of red and panic sell instantly, crashing prices 3 to 8% in minutes. Then they cancel 99% of those orders in milliseconds. They were never meant to be filled, and they quietly buy back the cheap silver they just created. They repeat this every options expiry and every time price threatens psychological levels. This is a documented manipulation playbook used repeatedly. But here's the thing. Manipulation only works when there's enough physical metal in the system to absorb the selling. When inventories are deep and demand is weak, you can suppress prices indefinitely. But when inventories are at decade lows, demand is surging, and supply is being rerouted, the manipulation breaks. And when it breaks, the move is exponential because all the suppressed demand that was pushed down for years comes flooding back at once. For the past 3 weeks, we've seen a pattern of price falls or crashes on Thursday and Friday. But today, Thursday, the price did not fall. The Thursday pattern has been broken. Tomorrow is New York monthly options expiration day. Based on historical patterns, options expiration days are when the suppression tactics are most aggressive because that's when the maximum number of call options expire worthless, transferring wealth from retail traders to market makers. But if the Thursday crash didn't happen, it suggests the sellers either don't have the inventory to push prices lower or they're choosing not to because they see what's coming. Either scenario is bullish. If they don't have the inventory, the squeeze intensifies. If they're choosing not to sell, it means they're repositioning to the long side. Let's be clear about the bearish case because it warrants examination. The Iran deadline could result in a deal, removing the immediate conflict premium. Trump has a history of talking tough until markets believe him, then backing down. Mining equity undervaluation could persist if institutional capital remains focused on tech and AI. China's backwardation could resolve through a seasonal production increase. The hemispheric silver realignment is still developing, not fully implemented. First Majestic's results could be an outlier, not a sector-wide trend. Thursday's price pattern break could be a false signal. U.S. debt projections assume a baseline with no catalyst to trigger a crisis. These are valid counterarguments, and anyone operating at a professional level should consider them. But looking at the data objectively, the weight of evidence is on one side. The Iran deadline is now just 10 days away, with bombers already positioned and oil already up 12%. First Majestic is demonstrating what happens when miners operate at real prices rather than suppressed levels. In China, buyers are paying deferral fees to avoid delivery amid decade-low stocks and record backwardation. Hemispheric concentrate flows are redirecting from Latin America to the U.S. instead of Asia, creating structural supply constraints. For 2 consecutive years, there have been zero gold discoveries, unprecedented in recorded history. The mining sector sits at just 4% of global assets versus a 24% norm, requiring a 6 times move just to revert to the mean. Central banks are buying gold at record pace, breaking a 2-decade trend of net sales. U.S. debt trajectories point to $64 trillion without a recession, and the S&P is flashing a rare dual overbought-oversold signal that historically precedes major moves. Not opinion, pattern recognition. You can't unsee it. What we are witnessing is a wealth transfer, not a market crash where everyone loses. A transfer where wealth moves from those holding paper promises to those holding physical assets, from those trusting institutions to those trusting mathematics, from those believing the system will continue indefinitely to those recognizing the system is already in the process of changing. This has happened before. It will happen again. Same pattern, same sequence, same outcome. The Roman citizen who held his wealth in debased denarii lost everything. The one who held land and gold survived. The Dutch merchant who trusted the guilder was wiped out. The one who moved capital to London preserved his wealth. The British investor who stayed in pounds watched his purchasing power collapse. The one who shifted to dollars maintained his standard of living. Today, the question is the same. Do you hold paper promises or physical assets? Do you trust institutions or mathematics? Do you believe the system will continue, or do you recognize the system is changing? The smart money is leaving. Not might happen, will happen. Mathematical certainty. This is not financial advice. This is financial warfare education. What happens next depends on whether you recognize the pattern before it completes or after. Most will recognize it after. By then, gold will be 10,000, silver will be 150, and the window to position at current prices will be closed. Subscribe if you operate at this level and want to stay ahead of what's coming. Ignore this if you prefer to believe everything is fine until the day the ATM doesn't work and the grocery store won't accept your currency. The data is public. The pattern is clear. The outcome is not in question, only the timing.